Everybody, Josh Sigurdson, World Alternative Media here, and we are joined once again by Lior Gantz of Wealth Research Group, a man with great insight on the markets and the economy. So welcome back, Lior.
Hey, thanks for having me back.
Absolutely. So interest rates are rising. We're seeing zero reserve policies at many banks, and we know that every single fiat system throughout history eventually fails. What's your take on the most recent movements the U.S. world reserve currency has made?
I think the dollar is not in danger in terms of internal risks. In other words, what the Federal Reserve is doing is creating a lot of chaos for investors. They're hiking interest rates. So we've seen since December of 2015, when it was zero, the official Fed funds rate. It's now been hiked several times, but historically, if you look at the Fed's funds rate and if you look at the 10-year yield, it's still very low. So we're playing around with the 3.2% for the 10-year, but think about it, even the official inflation rate is about 2.8%, 2.5%, depending on which one you're judging and when you're listening to this interview. But what this means is the government is telling you, hey, if you loan me money for 10 years, you'll make 0.7% in real purchasing power. Or in other words, what they're telling you is, hey, we don't want your, if you want to make money, that's not the way to do it. We still are not going to pay you any generous yield. So with that in mind, that is one reason that the stock market, even though there's a lot of problems, rising inflation and the trade situation with China, and the fact that unemployment is very, very low, which is a good thing for the economy, but for the stock market, it's not the best of situations. So the stock market does much better historically when unemployment is higher, because there's room to grow. So
well, and a lot can be said about, I mean, we're going to get into the markets quite a bit in a moment, but a lot can be said about the labor force participation rate in the United States, which also hides a lot of the employment numbers. After a certain amount of time, if you're not looking for work, suddenly you're not part of the unemployment number.
Sure. Look, about over 100 million people are not in the labor force in the United States. So it's a country that has a large retiree population, currently about 53 million, and it's going to be about 60 million by the end of the decade, probably even more, depending on medicine and onwards. The centenarians, the people that are 100 years and older, are actually the most they're the fastest growing demographic group in the United States. So there are going to be about 500,000 people that are 100 years and older, and we can get into a long discussion about this, but the way that the Social Security and all of these social programs were built initially during the industrial age in Europe, when the voting rights were given to the masses, politicians needed to come up with a way to become more popular, and they started with, hey, we'll pay you pensions when you're 57, but the average life expectancy at that point was about 48, 49. So it was a good idea, right? A good idea in terms of it made sense for politicians to promise something that they'll never have to actually do. So they under-promised, but now it's the other way. They're over-promising. So they're telling people they're going to start receiving pensions at 65 or 67, but people are living, 72 is the average, but people are living much more. So you get into a situation where countries just cannot take in enough in tax revenue and other taxes, in income tax and other taxes, and states cannot do the same thing for their own states' pensions, and then still pay out Social Security, income security, the interest rates on the existing debt, defense, and Medicare. It just doesn't work that way, and that's why you see $1 trillion plus deficits, annual deficits, and for 2019 it's going to be 1.3 projected, 1.3 trillion.
Well,
dollars.
yeah, actually, that's something I wanted to go into briefly. Was there have been studies that have been done in recent times. I went into this a little bit with you last time we had you on about how by the year 2050, they're looking at a worldwide pension shortfall of potentially as much as $400 trillion, with people born in 2007 living to 103 on average, which is like the most unsustainable thing I could possibly think of. But with that said, there's a pension shortfall, there's housing bubbles, there's rising pressure in cities around the U.S., countless other cities around the world as well within the housing markets. There's an auto bubble, an estimated multi-quadrillion dollar derivatives bubble. China's got 50 million empty apartments. The big banks all have terrible cash to deposit ratios. I mean, what do you think? Are we facing possibly the greatest market crash in history?
Um, it's debatable. It's debatable. Just to go back 1 second to your first question regarding the reserve currency, the situation right now resembles the late 60s in terms of we've seen monetary inflation. So we've seen central banks pumping liquidity, and we've seen the economy expand and recover as a whole. Not for every person, right? Some people, you ask them, they say they're worse off than 2008. But as a society as a whole, the economy has recovered. And this is a situation that resembles the late 60s. And what I'm trying to tell you is that the next decade, you might see rising inflation, rising interest rates, and stagflation with the stock market. So a sideways market or a bear market, and a very good decade for commodities. So all this pent-up demand in terms of dollars, there's a lot of dollars on the side, a lot of cash in with institutions, with corporations. We're not in a leveraged environment like in 2008. So when you ask me about, and therefore the dollar's reserve role is not in jeopardy internally. The Fed is not mismanaging the supply of money in such a way that the rest of the world is panicked about this. In fact, they like higher interest rates because they can. 40% of the deficit for the United States is borrowed into existence by foreign investors, so that no other country is financed 40% by outside money. The U.S. does, and therefore higher interest rates obviously are better for the lenders. But internally, there's not that big of a deal. What the Trump administration is doing with trying to negotiate or renegotiate all of these trade agreements, it's scaring the rest of the world in terms of what the future holds for the United States, and that could potentially put the dollar reserve currency role in check, because other countries will start feeling that, hey, we used to get foreign aid. The United States, we lended money, but in return we got a lot of favors our way, and now it looks like they want to play fair. So if they want to play fair, I'm not going to finance their debt anymore. I'm not going to finance their their social security and defense spending, etc. If they want to play fair and not play a different political game like we've seen in the past 30 years, then we're just going to play that same game with them, and we're not going to keep expending our dollar reserves. Now, when the rest of the world stops to increase their dollar reserves, as China and Japan have already done for 10 years, which is why the Fed had to come in and buy a lot of the debt since 2008, because the rest of the world just stopped going to the auctions like they have for since the 80s. And therefore, this is the big problem with the reserve currency. What happens when a lot of the foreign money, 40%, like I said, of the deficit or the budget is financed by foreign investors, or foreign entities or governments. So if that happens and they start to accelerate this process, you have a problem, because then the U.S. will need to print currency, not do a QE program, but actually print currency, and that is very inflationary, and that is very problematic for the dollar. Now you see the dollar is trading with the index for around 97, 96, 97. It can go as high as 105 on the technical level. But on a long-term basis, once we hit the next election cycle and we go into a more recessionary environment, the expenses are not going down in a recession. You still need to pay the same amount of Social Security. You still need to pay the same amount of interest rates. Still need to pay income security and more, because there are going to be more unemployed people. And you still need to pay for all the Medicare and Medicaid. So in a recession, you got the same expenditures, but you got less tax receipts. Mm-hmm. So that shortage is going to create a lot of pressure on the dollar. And I can see the index during the next 5-6 years as we enter another dollar bear market, because we've been on an 8-year dollar bull market, and they usually last about 7 to 8 years. Mm-hmm. So once we see the dollar bear market, it could go down all the way to 75. The 75 on the index, that's very low. That's a 25% reduction in purchasing power. And that's when the rest of the planet, the big countries, Germany, China, Japan, and probably France, Italy, the large governments in terms of GDP, India, will want a different solution. Russia, obviously, in there, will want a different solution. So we could be 5 years away from a major shift in terms of the G7 or G20 when they talk about, hey, let's change this reserve currency role for the dollar and go elsewhere. So
that actually sounds very similar to what I heard Kudlow say not too long ago, kind of like 5 years away. I mean, the 7-year average kind of reminds me of Jeff Berwick's Shemitah warning. But I mean, there does seem to be a trend of that 7-year average of bull markets. But I wanted to kind of also mention that, I mean, there's all these currency swaps going on around the world. China with Saudi Arabia, for example, this new European payment system outside of the US dollar. There's the IMF talking about basing their headquarters in Beijing. I mean, there seems to be a lot of momentum towards China over the US dollar going forward as a world reserve currency. What are your thoughts on that?
So 25% of the world's GDP, a quarter of the world's economic activity is still in the US. It's still the largest by far. China has become a major player with 15% of the world's GDP. 50% of the world's economy relies on China. So within those two countries together, you have 40% of the world's economic activity in two countries. So these are the two superpowers. If you put in Germany and Japan, 4 countries are over half of the world's economy. That's a very concentrated planet. And so whatever these countries determine will be the future for the rest of the century, right? Now, China is in terms of its population, it still hasn't seen a move into services. So it's still a very much a manufacturing economy, though there are 50 countries out of the world's countries that manufacture cheaper than China. So they are getting more expensive. The manufacturing is moving even to cheaper countries. So they're moving into a services economy with a large middle class, but we are probably 20, 30 years away from them becoming like a middle class economy. So they are going to keep growing. They're probably going to eclipse the United States GDP in about 7 to 8 years. So about 2025 is the projection. This is by the UN. And by 2037, they're probably going to have the world's largest army in terms of budget. So the world is shifting towards China. The middle class boom is moving towards China. They have major problems because any country that has 1.5 billion people is going to have problems. But yeah, the world is moving towards China, and obviously India comes next. India actually has a very booming economy as well.
Yeah, they're also opening the doors to a more centralized cashless system in both China and India, and both the first and second biggest populations on Earth. China has made massive strides in the last 30 years. It's unbelievable how fast they've grown. I mean, they've gone from relatively primitive in the early 20th century to one of the fastest booming economies, one of the fastest booming infrastructures on the planet. It's absolutely overwhelming considering the amount of time that's elapsed. collapsed. But with that said, you heard me go into the markets. There's many different issues in U.S. markets as well as around the world. I mean, in Berlin, they're not allowing people to renovate their own homes because it might increase the value of their homes. That was a new law that was passed that we recently reported on that only German mainstream media is talking about. But with that said, I mean, there's a lot of examples of hyper bubbled markets, whether it be housing, the derivatives bubbles, pension, you name it. So like I kind of went into, do you think that we're heading towards like the biggest market crash that we've seen in history? Because a lot of financial trendsetters and economists seem to believe that that is where we're heading.
So, I created a special report specifically for your audience because I've listened to many of your shows. You have a very sophisticated audience. And if you go to wealthresearchgroup.com/crash and /bonds, you can download 2 PDF reports discussing this particular question at length. And if you go to wealthresearchgroup.com/portfolio, you can get access to how I'm positioning myself, diversifying myself within asset classes to meet this question specifically. Now, to answer your question, for investors to liquidate their stocks portfolio in a similar fashion to what we saw in 2008 or to what we saw in 2000 or in 87 or in the big market crashes, first of all, you need to have a recession. So the worst market crashes happen in a recession. And we are moving towards a recession in the United States. A recession usually happens once unemployment rates bottom. In other words, the employment situation is as optimal as it gets for this current economy, and then you start to see a year-over-year problem. So you see more layoffs than hires, and when you couple that with higher inflation, you see margins for companies start to deteriorate because they don't need to hire anymore. Their productivity is maxed out, and now they're either cutting down or their profits are decreasing, and they can't create the same margins, and so that creates a recession in the economy. Higher inflation, which means less spending, and then less profits for the corporations, so they can't hire, and the entire economy slows down, contracts. And obviously, you couple that with higher interest rates and with the fact that the Fed is not accommodating anymore. It's selling its bonds portfolio, so it puts a lot of pressure on the free market to buy more bonds. And this will all happen in the next year and a half, 2 years. It's in the last bit of the cycle. There's no reason to pinpoint it to a specific time. You need to just start to prepare for this. And when that happens, it creates a situation where the multiples, the amount of money or the price that investors are willing to pay for stocks is lessened. So you're seeing a contraction in how valuable stocks are compared to other asset classes. For the meantime, what can yield as much as a great dividend paying stock? There's not a lot of things out there that can do it. And therefore, even with all the bad news, you're not seeing the market crash. You're seeing it go sideways, trade in a range like it has in 2018, but you're not seeing any liquidation, any major profit taking. For this to happen, for a panic selling, for people to change their paradigm completely, altogether regarding stocks, there needs to be an alternative asset class that becomes very attractive. Now, bonds, even if the 10-year bonds go from 3.2% to 4.5%, 5%, which is closer to the historical average, this is still a situation where bonds are yielding about 5% for a 10-year bond, with inflation at about 3%. So you're only making 2% in real money. And you have stocks that for the next decade are projected to yield between dividends and multiple appreciation and EPS growth, so earning per share growth. They're looking to generate about the same, so 5%. So in real money, stocks and bonds are probably going to be on equal footing for the next 10 years at about 1.8 to 2% a year. That's very low. Now, if you have a situation where there's about a 3 to 3.5% inflation, and that's sort of the 10-year bond is yielding the same, then commodities do much better. So as this paradigm shifts from a world where stocks are favored to a world where stocks and bonds are probably on equal grounds, but both deliver very low real world yields, then commodities become much favorable. We're not there yet, but once that happens, there's going to be a shift out of stocks and probably not into bonds, but into commodities much more. Like I said, like in the 70s. So um, when you look at the asset class world and where corporations and institutions and hedge funds and private money and private equity firms can put trillions of their own dollars in, there's no reason for them to move trillions of dollars that they have currently in stocks into other asset classes, but they will have a reason to do so in about a year and a half, 2 years once the recession hits, and then they really need to start thinking about taking profits. Whether or not this creates a 20% decline in the stock market or a 40% decline has to do more with whether or not the Fed mismanages the amount of interest rates of hikes that they do, if they accelerate it too much, or if there's geopolitical problems. Because for investors to really put a lot of pressure on stocks, there needs to be a forced liquidation event. Like in 2008, where people needed to raise cash. Right now, investors are not in need to raise cash. So for them to sell good companies, great companies that are making good profits at half of the price, just that is a situation which doesn't have to happen. So when people say that it's going to be the worst, market crash ever, a 50%, I've heard 75%. I heard we're going back to the 1999 levels. For people to really sell stocks in such a major way, there needs to be some sort of a liquidation event that really is unprecedented. I don't want to call that because it doesn't have to happen. Now, regardless if it's going to be 20%, 25%, 30%, or 40, 50%, what you need to do is you need to have a plan for how you grow your income in the next decade, because for sure, once that is over, you will see either a bear market or a sideways market for many years to come. So because you're going to have higher interest rates, higher inflation, really no reason for stocks to gain in multiples or an appreciation. Dividend income will be much more important than where the stock price go. The stock prices are for the S&P 500, for the most part, are probably going to be flat after the market crash for many, many years. So you're either going to be a stock picker, you're going to find specific companies that are going to be beating the index by a long margin because they're just growing very organically and rapidly, or you're going to rely more on dividend income. And the third option, like I said, is you're probably going to see a great economy for commodities. So with that in mind, I think that is more of the burning question. Now, in anticipation of this, go over your portfolio and start looking at whether or not you have a lot of stocks that rely on growth. Because if you do, they're not going to be favorable during the market crash. What is going to be very favorable, and you're already seeing this, is value stocks, companies that rely on very predictable, recession-proof businesses, great profits. You can go back to 2007, 2008, 2009, look at which specific companies still were able to grow their profits, grow their earnings during the recession, pay increasing dividends, and that's where the money is flowing right now. You can look at Coca-Cola, 52-week high. Just giving an example. I'm not giving you any companies that I'm personally buying. But Coca-Cola is at a 52-week high. Procter & Gamble is at 52-week highs. You're seeing more and more of these companies. McDonald's is 52-week highs. So you're seeing more and more of these companies that are able to grow through recessions that investors are going and buying stocks at. And you see the FANGs obviously deteriorating in price by a major way. So this is where investors are thinking the economy is going and are preparing in advance. Now, we are going to cover this at length at wealthresearchgroup.com in the newsletter, because I am positioning, obviously, personally in these sort of situations. And every 2-month period, every 60 days, I create a full overview of everything that happened in my portfolio for the past 60 days, anything that I'm still holding, anything that I'm buying or selling. So this is part of the routine for the newsletter.
Well, you mentioned something. I want to move on to something a little bit more macro level. You mentioned something earlier about, preparation, and of course, being overly prepared is always better than being underprepared. And with that said, your father went bankrupt 3 times in your life, and similarly, my parents went bankrupt when I was about 13, and it motivated me from then on to try my best to understand money and avoid that ever happening to myself. What was the impact that your father's bankruptcies had on you, and what did it teach you going forward?
It's a great question. So the first time it happened, I was 13, and I started to have my own desires, right? Whatever it was at 13, I needed money to go out with friends, to do whatever I want, right? So that first bankruptcy forced me to go into the labor force, and I was about 1 meter 49. I think it's 4'11", right, in American measures. So very, very short, and it gave me the impression that I'm a little boy, and I needed to generate some income, and it forced me to be creative. So I think that first bankruptcy, what I did was I went to a clothing store that was in my neighborhood, and I hung around the clothing store for 2 weeks, every day for 2 hours. And it was a family owned clothing store. So what I did was I showed the owner every day that I know more and more about the brands. I used to go every day home, research these brands, come back tomorrow with more information. And for 2 weeks, I just did that and just told him, look, I'm looking to get hired. I'm looking to get hired. Just pushing that on him. So 2 weeks into this lady comes into the store, and I upsell her. She's looking for a few items, but by the time she hits the register, she's buying a lot of stuff. And this is just me talking to her, not an employee or anything. So at that point, he hires me, $4 an hour. This is 1997, the beginning of saving money for me. So I started to save money, and by the time I'm 16, I have, with today's money, about $20,000 saved up in 3 years. Just working at the clothing store, painting decks, babysitting in the neighborhood, delivering pizzas, all that kind of stuff. And I get my parents to sign a waiver so I can run my own bank account. The reason being that my banker tells me, hey, you have some savings. Why don't you put your money to work? And he introduced me basically to the theme of investments. So I think starting very early is something that's you either have it or you don't, right? But it either happens to you or it doesn't. But for me, it happened, and that was sort of the blessing of my father's first bankruptcy, because it made me start investing when I was 16, and it was 2 months after the dot-com bubble burst that I started buying stocks. So it was actually great timing. Obviously, didn't have anything to do with me. But what happened was I bought 2 books. Basically, my grandfather gave them to me. One was Peter Lynch. Peter Lynch, if you Google his name, he was the greatest investor of the 1980s with a 29.7% annual return, which no one has been able to do that for a 13-year period as he has done. But in his book, Josh, he talks about the fact that some of his best stock picks, his teenage daughter gave it to him, because it was just businesses that she knew a lot about, like Dunkin' Donuts and stuff that teenagers know, right? Some card companies, like basketball cards, etc. So that gave me confidence to look at what I knew as a 16-year-old and start to invest in that. So I knew a lot about clothing because I worked at a clothing store. And so I invested in the largest apparel manufacturer in the world. It's called VF Corp. It's a holding company. Nobody knows the name VF Corp, but everybody knows the brands like Timberland, the North Face,
Mm-hmm.
Lee, Wrangler. They own a lot of these, and so I invested that sum initially in that company. It's gone up 17 times, like a 1,700% return since the year 2000 till today, not including the dividends. So that's where the power of dividend investing came to me, and competitive advantages. So it was the largest. I knew it was a very good stock in terms of what it brings to the table, because the other book I was reading was Warren Buffett, and he always talked about financial moats, like a competitive advantage. What keeps new companies or competition from entering and defeating the champion, the dominant. And so that's sort of been my fascination, my obsession, to find these rare businesses that are able to grow their earnings, grow their profits, and move away all the competition, not let them come in. So I think that is what the first bankruptcy brought to me. The second one happened already when I was after IDF, so the mandatory Israeli 3 years that you do from 18 to 21. Mm-hmm. So that happened right after. So I'm already a civilian now. I'm looking at the future, looking at what to do, and boom, it happens for the second time. And that encouraged me to go into the entrepreneurial section of the bookstore. So until then, I was thinking investments. Now I'm thinking, how do I make sure that I don't go bankrupt? And that taught me a lot about cycles and the use of leverage and the wrong use of debt, etc. And so I've been debt free. Like, that was a big thing for me, a big theme. And the other thing I've learned in the entrepreneurship world is you need to have partners. If you can have partners, they offset a lot of your weaknesses and they help you grow the business much faster. Because if you're focused on one thing, and then it means you're not focusing on many other things. But if you have partners, then you are focusing on more things at once, which is probably the most important thing for a business starting out, because one person doing everything is just very hard. Mm-hmm. So partnering up has been the greatest lesson of the second bankruptcy, I would say, along with staying out of debt and appreciating market cycles. So or business cycles. So don't go into the right business at the wrong time, I would say. And then, the third bankruptcy just it frustrated me. I was 26. My father was 60 after 2 heart attacks from all the stress that had happened to him from businesses, and I just felt very sorry. Mm-hmm. And what it did is inspired me to become wealthy so I can support my parents. So I think that's sort of where it inspired Wealth Research Group to be birthed, to be born, the newsletter, because I thought, man, if my father at 60, I when I talked to him about business, even though he's been in business since he was 20, if he doesn't have many of the tools that I have just from reading books at 26, then there must be millions of people like him. And so that's when Wealth Research Group was birthed. It was birthed many years later when I was 32, but the idea of sharing information, of reading a lot of investment books throughout my 20s and sharing the information, sharing the entrepreneurship information with the audience, with in a free financial newsletter, that was like my baby, my dream. And 3 years ago, we launched Wealth Research Group, and it will continue being the way that I kind of transfer what I learn, what I know, to the readers. And it goes on. It's on macroeconomics, like you said. So it goes on. It talks about the Fed and interest rates and current events, but it's also very specific. And 2 months ago, for example, I wanted to invest in the middle class explosion in China, and so I thought, what would be the best way to do it? And Starbucks, of all companies, for example, I'm giving you an example, it opens a branch in China every 15 hours. And the stock was trading in a range for 3 years. If you look at their chart, you'll see it. So at $56 per share, I got in. A few days later, it was disclosed that Bill Ackman, a billionaire hedge fund manager, has put $900 million into it, and it started popping. and now it's at 68 like a month later. So it's already like a 15% gain or whatever that comes out to. But I shared that with the subscriber in the newsletters. So we are talking about specific things as well as it's a mix of both.
Mm-hmm. Yeah, and I feel like this is the kind of stuff, the stuff that you talk about at Wealth Research Group, is the kind of stuff that you won't hear on television. It's not the kind of stuff you'll learn in most schools, at least public schools anyway. People aren't really prepared for that type of striving for success and, being ambitious to gain that kind of success. Instead, they're focused on their math homework or science homework and stuff like that. And that's fine. But I think the tools for life rest in financial sustainability and independence. And I think that that's a really important lesson that every young person should learn going forward, because we see vast amounts of debt. We see so many kids in so much debt, with their university debt, with the baby boomers in massive amounts of debt, also keeping up with providing for their children that are millennials. There's a big problem with that, and not enough people striving to be successful and break through that wall. But another thing that you're not going to get taught too much.
I couldn't agree more, by the way, and just to tell you something, in all the years that I've seen, I believe this is deliberate. Mm-hmm. I think this is the marriage of the elite and governments, and all they're doing is trying to, people use the word indoctrinate. Mm-hmm. This is a deliberate agenda. There is no other reason for public schools to not invest in buying all the children in the Western world, buying them 3 books that I think every person should read. And I believe every 13-year-old, if he reads these 3 books every month for a 12-month cycle and repeats that from 13 to 18, the world would have changed completely. 3 books, in terms of budget items, this is nothing. So it has to be deliberate. There is no other reason for all of these millions of people to sit down in classrooms and all learn the same information.
Well, let's go into that. Let's go into that a little bit, Lior, because
by the way, if you want to just saying, Josh, if you want to access the books that personally changed my own life, if you go to wealthresearchgroup.com/rich books, that is the list of books that I habitually read, like every single month.
Well, and I often go into this with my viewers. I left school in 9th grade. The reason I did that was because I felt like I was being indoctrinated and I wasn't learning. It wasn't to go, hang out in back alleys and be stupid. It was because I felt like I wasn't learning. And in the first month out of school, I learned more than in all my years in school because I read books. I strived to learn, and I didn't want to be dependent. And I mean, one of the biggest issues is there's this culture of dependence that is being pushed on the populace because it benefits the elite that you talk about. It benefits the government for people to be completely dependent. It benefits the banking system for people to be completely dependent, because if people can't be responsible for their own wealth, if people can't be responsible for their own work, if people can't be responsible for their own housing, I mean, that is what puts them on their knees, subservient entirely to the government and the banking system, etc. Vast amounts of debt, as we spoke about earlier. So what do you think? Is there, you mentioned you feel like it's on purpose. Do you think this is all about creating kind of a culture of dependency to make people more dependent and, I hate to use the word loosely, but almost slaves to the system?
For sure. When you have a situation that it's where I sort of differ from other people is they think that the elite is sort of a connected group that they all are friends with each other. They sit at round tables or conferences. There's literally I haven't seen any evidence, and this is looking into it for many years, that there's some interlinks between all of them. There are joint corporations and some families that own the same business as other families, but I think it's more of a silent partnership between everyone, um, between the concentrated, very much the elite wealth, um, which own which own a lot of interest in the media, in oil, etc. Look, everyone wakes up in the morning, consumes media. So if you can control the media, that's a great tool for you, and it's been used in all countries throughout the planet. Then everyone pumps oil into their cars. So if you wake up and you're an elite, a part of the elite, you need to figure out the amount of control that you have. Just think about it. Mm-hmm. Hundreds of millions of people, billions of people wake up and consume what you are giving them. Mm-hmm. You're giving them oil, you're giving them media, you're giving them food, you're giving them everything. So you want to make sure that they stay at that routine. You don't want them exiting this routine, because you're going to lose money, and you're going to lose your control. You're going to lose everything that you've structured. Obviously, money being the biggest game. So banking being the biggest game in town, and insurance, etc. All people are using these things, so they want to own all of these necessities.
And people want to put a name on it too. I've noticed a lot of people will go, well, it's all George Soros, or it's all Jacob Rothschild, or all, David Rockefeller and stuff like that. When it's the actions created by multiple groups that are doing this, people want to have a name or a face on all of this stuff. But this is a massive entity. I mean, they're doing it in China, they're doing it in Australia, they're doing it in the United States, Canada, elsewhere. I mean, it's just a function of a government to be dependent on the dependence of the populace.
Sure. Look, if Bill Gates or Jeff Bezos was to take all of his net worth and go into Phoenix, Arizona, and start buying real estate, in about 3 weeks, that money is already suffocated in the Phoenix real estate market. The world is so rich. Mm-hmm. Any one person is nothing. Even the richest person on the planet, or if you think the Rothschilds have these massive trillions of dollars of wealth, or the Rockefellers, etc., it's still compared to what the planet is worth and what the equity situation in the world is. It's nothing. What they do is they operate think tanks. They operate behind the scenes on governments. They instigate conflict where they need their companies to make money on war, or make money on peace, or make money on net gas or oil or whatever. They just shuffle the cards behind the scenes. But what they need for all of this to happen is for people to get excited about politics, for people to get excited about mainstream media, for people to get excited about the American dream and go and take out a mortgage. And now your options are, the more liabilities you have as the middle class, because that's what the middle class has most of the time. They have a lot of liabilities, car payments, insurance payments, all these payments. You're stacking all of these payments, and then you have one source of income to supply for them, and therefore you stay in that cage where your income gradually goes up a little bit at a time, and then you want to make your lifestyle better, so you have more expenses, and then one thing needs to pay for all of these things, so you can never go into a situation where you don't have an income. And where that differs from entrepreneurship is you learn, first of all, to cut off all of these non-essentials at the beginning. Don't look for that middle class lifestyle in the beginning. Look for ways to create income streams, and then after you have either one income stream that's amazing, so like a business, or you have multiple income streams from your job and then from other secondary income streams, then you can look and see, what does this help me attain here? How can I still make money, still save, and facilitate a nice lifestyle, and you don't fall into this trap. And like you said, if you're 20 years old or 21, sorry to come in there, but just to finish my thought, if you're 20 or 21 and you have $100,000 or $150,000 or $200,000 worth of student debts, that immediately forces you into a situation where you have to get an income stream. and maybe it's not that income stream that you really want. Maybe it's not your passion, and it's not your dream job, or the venture that you want to go into, but your options are limited because you're already in debt.
And we have to finish it up because we're running out of time, but I did want to mention this one last point here, which was this push by the media, exactly with what you're saying there, to divide people. I mean, regardless of whatever side of politics you might be on, there's this constant need to divide people because it distracts people. People will fight themselves, infight, focus on the collective rather than, focus on their own future, focus on the real, I guess you could say, enemies or problems within society. Instead, everyone's fighting each other and everyone's just trying to live paycheck to paycheck one day after another. And, but someone has a slightly different opinion than them. So they are the new enemy and they must fight them because they've regurgitated what one side of the media or the other has told them to say, and they just do repeat after me, the whole Simon Says kind of thing. And that is something that I feel is very distracting from being able to strive for that success that we were talking about earlier, to be able to be independent, to be able to be responsible for your own well-being, your own wealth, instead of focusing on these obvious trigger points or distractions to get people attacking each other, which is why we have the rise of Antifa at the same time as we have the rise of skinheads and etc. I mean, this is all perfect distraction from these really important things that, real issues that are affecting us, from the banking system to the government, the monetary system, things that are happening in the markets, market manipulation, etc. Most people don't understand money, but they know how to fight with each other. And I think it's about time that people sit down, read a few books, go to Wealth Research Group. There's a lot of great information there. Understand what they're saying, educate yourself, because an educated populace is a resistant populace, is an independent populace, and freedom's main objective is for people to be responsible, because you can't have one or the other. You have to have both. Responsibility and freedom play hand in hand. And if people understand money, if people understand how to take care of themselves, they will find themselves true freedom away from all the noise that's going on in the media today. So, Lior, I really appreciate you joining us today. We could go on about this stuff all day. Lots of interesting stuff to talk about, as always. We'll definitely be having you back again sometime soon. But as we close it off, let people know where they can find more information about you and your work.
So our highest priority, top-ranked information that we put out is in the newsletter. And you can just go to wealthresearchgroup.com and subscribe on the main sign up. If you want some good weekend reading, and you can go to the site and you'll see on the top menu, it says special reports. It's like a wealth library of many special reports and PDF reports on many subjects. And if you want to, if you want to buy some books and do some serious reading, just go to wealthresearchgroup.com/rich books. It's a list of the books that I'm personally reading all of the time, habitually, and it might be something that's worthwhile to you. These are books that are world famous for many people that have used them to their advantage in life.
Absolutely. Well, I really appreciate you joining us again. And until next time, this is Josh Sigurdson signing out from World Alternative Media. Find the truth, be the change. Like what you see here, OM? Don't forget to check the links below. GoFundMe, Patreon. We can't do it without you. Any donation is very much appreciated, especially as we are so vastly demonetized and censored on YouTube, as these guys come in and flag all of our content as hate speech. Also, check out our Bitcoin address below, as well as on the screen for you to scan if you please. And also check us out at steemit.com. We're at Josh Sigurdson. It's a future of social media where you get paid in the upvote of your post in cryptocurrency, Steem that is. So make sure to check us out there. Make sure to join us at Anarchapulco 2019 with people like Ron Paul, G. Edward Griffin, of course, Jeff Berwick, Vid Jedlicka. So many incredible speakers are going to be speaking. It's just a massively growing event. It is something you have to see to believe. So make sure to check it out below and save money on your tickets tickets by using promo code WAM, that's WAM, and I hope to see you there. Also, check out our newsletter as we are getting demonetized and censored and all that. We don't know what comes next, so we have an email, worldalternativemedia@gmail.com. Send us an email with subject line YES, YES, and we will include you in the newsletter where we will continuously keep you updated. So until next time, thanks for watching, everyone. This is Josh Sigurdson signing out from World Alternative Media. Find the truth, be the change.
I'm sure you have already changed people's minds in your young age because you're involved, and I like that.